Jeff Rosenberg, we went curve inversion off of this, now -1 basis points. Let's go back to Carnegie Mellon and talk to me about the nuances and disaggregation of curve inversion. There's zero. There's a little bit inverted. Maybe there's more inversion. What is that nuance within this boom economy?
Well, Tom, this report is just reaffirming what the markets were expecting and that trend that you were talking about in terms of the bond market of yield curve inversion. You know, no surprises in this report, as Jonathan just mentioned. The headline report, the headline number miss is really minor. It's the strength in the labor markets that's being seen here again, and that's the challenge for the Fed. For the markets, as we're seeing a little bit this morning, a little bit more curve flattening, it is really much more about, as Mike McKee was kind of highlighting, you know, this is good news, but it's a little bit too much of good news. And this is an economy and a labor market that's overheating. The Fed has to accelerate. Lots of expectations. You talked about at the top of the show some historic bond market and really financial market losses in the first quarter. This is the markets readjusting to a much faster pace of Fed normalization. And today's report only will reaffirm that view. And that's what we're seeing with that little bit of flattening continuing in the market that you're talking about.
Jeff, for you, is this good or bad news when it comes to investing?
To investing, you know, I think it's just a reaffirmation of our expectations. Not good news or bad news, but just this is what we expected. And what we expect is this is a very difficult environment for investing because of the challenges of the dual aspects we're about to go into. We're talking about for the May FOMC, you know, the shrinking of the balance sheet and, you know, markets are pricing in a move towards a 50 basis point hiking cycle. This is a very, very dramatic turnabout. That's why you had such a negative price performance across fixed income in the first quarter, because we're waking up to the idea this is a Fed that wants to get out in front of the curve, and that means a very accelerated pace of tightening. That's a challenging environment for investing, as we just saw in the first quarter. When we get to the backside of it and to some higher rates of real interest rates eventually and higher levels of yield, this will be an attractive environment, but the transition, it's very difficult environment for investors, as we saw in the first quarter.
Do you think that it's basically a lock that we'll get to, we'll have 1 percentage point increase in the Fed funds rate by June?
You know, I wouldn't say it's a lock. It's definitely well, it's about 90% priced in terms of the market. You know, you can't say it's a lock because obviously some things can happen in the geopolitical side that we're all focused on. If that were to take a more dramatic turn that you saw in terms of risk-off environment, confidence shock, you know, the shocks can be important. And financial conditions tightening, which to date is been accelerated but is still on the longer view, very accommodative markets. If you had financial markets kind of get really far ahead of where the Fed wanted to go, you could certainly slow that pace. So I wouldn't say it's a lock, but given what we know today and the fundamentals of the economy, what we see out of this labor market report, I think the odds are very high that we're going to have 250s back to back in the May and June reports.